Money laundering is a scourge on the planet. An estimated $800 billion to $2 trillion is laundered every year. That's why anti-money laundering laws were established, to make it harder to hide money and get away with crime and corruption. It's a battle being fought by regulators, compliance teams, and good businesses everywhere. Money launderers hide proceeds from illicit activities in real estate, businesses, casinos, shell companies, and numerous other schemes to legitimize their ill-gotten gains. They launder their money through banks, which were generally the first institution to come under AML laws. Brokers, any financial services or money services business also needs to implement AML. Or Bitcoin. The launderers are always adapting, always looking for new ways to cheat. And AML laws expand to cover new methods, close loopholes, and try to tighten the financial rope around these miscreants. Compliance departments put those regulations into effect at regulated companies such as banks, financial institutions, and money service businesses to help ensure that the companies don't face fines, sanctions, or reputational damage. AML is a critical defense for societies, trying to help shepherd funds into the public good, not criminal hands. AML compliance is vital work. There are 3 stages of money laundering. 1. Placement, when the dirty money enters a legitimate financial system. 2. Layering, using multiple complex transactions to hide the source of the money. 3. Integration, when the clean money returns to the criminal via legitimate sources. While each stage of the process is necessary for the money launderer to get their dirty funds cleaned and back into their hands, it is the first step, placement, that provides the best opportunity to stop the operation. After all, placement is when the money has the closest connection to the crime, and there's less chance that the true source of the funds has been obscured or diluted. For that reason, transactions in cash are an excellent place to start when creating AML compliance policies, programs, and procedures. If there is a large cash transaction, where did the money come from? If there are numerous cash transactions in the same account, why is there so much cash being transacted? If there is a big spike in the number or value of transactions, why? Does the business deal with lots of cash? Does it deal with countries or organizations that are known to have issues with money laundering? There are often set transaction or threshold limits that provide rules on the use of cash and what is suspicious and requires investigation or reporting. One best practice is taking a risk-based approach, understanding the risks of various activities and accounts, and modifying the level of risk management and controls accordingly. Creating a good AML compliance program should not be left to chance. It requires careful strategic thinking, robust operational procedures, and ongoing fine-tuning and analysis. While each jurisdiction and industry will have different requirements, here are some general rules. Have a written policy. Have a designated officer. Have employee training. Have systematic reviews. An effective AML screening program, which stops money launderers before they even open an account, is one of the best ways to help ensure AML regulatory compliance and risk mitigation. Know your customer. That means knowing your customer's identity, their financial activities, and the risk they pose. Requiring proof of identity to open a financial account is standard practice. Being thorough and accurate at this stage can help prevent the opening of accounts that are not connected with real individuals or by individuals associated with problematic activities. The same approach applies for opening business accounts. The identity of individuals associated with the business should be checked and verified. AML laws are increasingly requiring the checking of the ultimate beneficial owners of the business, the UBOs, to better understand the nature of the company and the people behind it. Beyond AML screening, there are many steps to ensure an effective AML compliance program, including monitoring and reporting. Accounts need to be monitored to ensure that transactions fit with the account profile and any unusual activities are flagged for further investigation. If suspicious activity does occur, reporting to the regulators is necessary to help track and potentially lay charges around criminal activity. AML compliance is often complex, ever-changing, and a source of substantial risk. As opposed to making it an afterthought, approaching AML compliance as a core requirement helps deliver a program that protects the organization and its good name. Helping your organization prevent the facilitation of crime and corruption is fundamental to modern financial operations. For more information about AML compliance, search AML at trulyu.com/resources. for over 25 different reference papers, case studies, webinars, reports, and data sheets.